Alright, Accounting 1 kiddos, welcome to Chapter 7. Chapter 7 is actually one of our shortest chapters, but one of the most important because we do learn how to prepare two types of financial statements. Our first one is going to be our income statement. Our second one will be our balance sheet. So as we talked about in Chapter 6, we're continuing with our end of period work. So our objectives today are to prepare an income statement for our service business, and then to calculate and analyze some financial ratios using our income statement amounts. So, we know that information needed by managers and owners to make business decisions is found in the general ledger. We learned that in Chapter 6, where the whole reason we start doing our end of period work is so that managers and owners can reflect back on the accounting period and then make informed business decisions to further their objectives. The information that we get out of our general ledger is very detailed. So to make it more usable, one of the most important bits of accounting is that we need to summarize, organize, and report it so that the owners and managers can use it. So there's two types of there's two types of accounting. Financial accounting is the area of accounting that focuses on reporting information to external users. This is what we are currently doing. In Accounting 1, we focus on financial accounting. In Accounting 2, we focus on managerial accounting. And that is where our accounting focuses on reporting information to our internal users. So the information that we use to make business decisions. The managerial accounting isn't really, people outside of the business aren't really interested in how detailed that gets. They're more interested in the broad summarization that happens from financial accounting. So financial information must be reported in order for good business decisions to be made. And an incomplete financial statement is kind of like a book that's missing pages. Imagine that you're reading a good book and you flip the page and you realize that there's some missing. You'd be frustrated. The same thing goes for a financial statement because the complete story isn't being told. So this brings us to another accounting concept, which is called full disclosure. Sometimes it's referred to as adequate disclosure. And all that means is that financial statements that are created by a business, that they contain all the information necessary to get a complete picture of a business's financial condition. So you just want to report everything, not try to hide anything. And that kind of goes back to in Chapter 1 where we talked about ethics. As an accountant, it's very easy for you to manipulate information. And so if you don't fully disclose everything, that could be cause for a business ethics violation. It could be cause for white collar crime, whatever it happens to be. So you want to make sure that you're disclosing everything. Also, when a business is started, it's expected that the business is going to operate indefinitely. Typically, you don't assume that you're going to start a business and then fail. So when an owner retires, usually as a sole proprietorship, it's expected that a family member will take it over, or they might sell the business to another person. But regardless, the business is going to continue on. And that's a second accounting concept we haven't talked about yet called going concern. And so all that means for us when we're making financial statements is that they are prepared with the expectation that the business is going to operate indefinitely. It's not going to just stop after 5 years. And then companies usually prepare a minimum of 2 financial statements each accounting period. One is an accounting statement, an income statement, and the second one is the balance sheet. And again, this follows the accounting concept of the accounting period cycle, where financial statements are always prepared at the end of each monthly fiscal period. And we've talked about that already, that we do that at the end of every period, as well as at the end of every fiscal year. So let's talk specifically about the income statement. The income statement is a financial statement that reports information over a specific period of time, and that's very important. It's important that we recognize that an income statement shows a period of time. It is not on a specific day. Okay? So what an income statement shows us is the financial progress of a business and whether they were earning net income or a net loss. Now, an income statement is going to have 2 sections. no, I shouldn't say sections. It reports two things. It reports expenses, which are amounts a business pays to operate a business and earn revenue. And then revenue is obviously earned by the expenses that are incurred. So I always like to think of revenue as the money that you make and expenses as the money that you spend. Okay, both of these have to be reported in the same period in which they were earned. Remember, that goes back to that accrual basis of accounting that we talked about in Chapter 6. So the information that we need to prepare the income statement is actually coming from two places on the worksheet. So let's see where they come from. The first part is that we need the accounting titles that are obtained from our accounting title column. And then we also need the balances that come from our income statement debit and income statement credit columns, as well as net income down at the bottom. So when we go ahead and start putting our income statement together, there are four sections we're going to look at. The first one is the heading. The second one is the revenue section. The third is the expenses section. And the fourth is the net income or net loss. Now, I will tell you that it's very important that these four sections are formatted in the correct way. The nice thing about MindTap is they will have all the formatting done. Your workbook will not, and neither will your test. So you need to make sure that you are aware of what the formatting looks like for each section. So the heading, of course, always goes at the top of your financial statement. Again, it's the name of the company, the name of the statement, and then again, we put the words for month ended, whatever the month happens to be. Of course, if it were for the year, it would be for year ended 2019, 2020, etc. So then our second section is the revenue. So what we do is we do write the heading revenue, and we put 2 colons, and then we leave this blank. And then we put our one revenue, which the only one we have at this point in time is sales. And then the sales amount goes over on the second column over here. This is very important, second column, okay? And that's the revenue section. Very simple. We just jot that in. Our third section is for expenses. So again, we have the expenses heading followed by 2 colons. And then we list all of our expenses in alphabetical order, just like they appear in the chart of accounts. Then, because we're going to be totaling these, we put all of our expense amounts in the first column. Do you see this? We list all of our expenses, and then we single rule here, indicating that we are going to do a total. And so then we write total expenses, followed by the total that we found. This is all of those added together. And there's our total expenses. That goes in the second column. The reason we do this is so that it's very easy for us when we're reading the financial statement to go, this is our total sales, this is our total expenses, okay? Again, because we're going to do a calculation, we do another single rule here underneath our total expenses, which will allow us to say we're going to calculate net income. So we take our sales minus our expenses, and that's going to give us net income, okay? So we put the title, net income. It could be net loss if that happens to be so. We put our amount for net income, and then we double rule across both columns. And that's the formatting for an income statement. Again, refer back to this slide if you need to get the correct formatting, because this is very important that you get it in the right columns, that you remember to rule correctly. Also note that the account titles are indented slightly to allow us to easily see revenue, expenses, and net income. So in order to have our income statement be more useful, typically we do a few additional calculations. And when we do this, we compare our revenue to 2 separate items. One is total expenses and one is net income. So what we call this is doing a financial ratio. Remember, a financial ratio is simply a comparison between 2 components of financial information. So our ratio analysis is where the calculation and interpretation of a financial ratio. And when we're looking at our income statement, essentially what we do is we compare everything to our total amount of sales, okay? And so sales is always going to be at 100%. We call this a vertical analysis because we're comparing things vertically. And you'll see this as we look on the income statement here, why we call it vertical. So here you can see we have sales at 100%. We take our total expenses and we divide by our total sales, and we get a vertical analysis ratio of 45.7%. Okay, which just means that of our total sales, 45.7% of that went to expenses. And then we do the same thing for net income, where we take our net income amount and divide by our sales, and of our sales amount, 54.3% went to net income. Okay, so that's all we're doing here, total expense ratio and total net income ratio. And all you do is divide by your total sales. Total sales is always going to be 100%. Okay, always going to be 100%. But do you see how we're working vertically? That's why we call it a vertical analysis ratio. Eventually we will have horizontal, but not at this point in time. So right now we're just going up and down, which is why they call it vertical. Here is an example of possibly having two sources of revenue. If that were the case, you would simply list both. Again, in the first column, do your single rule, okay, and then you would have your total revenue that goes in the second column. Also, you always run the risk of possibly having a net loss, and all that means is that your revenue was less than your expenses. If this is the case, please note that net loss is recorded in parentheses. For us as financial information readers, when we see things in parentheses, that means that that is a negative number. We don't usually put a dash, a little dash, like a negative sign in front of that, because that could easily be misinterpreted. So we put parentheses instead, and you see that both around the net loss number and also around the financial analysis. So we're going to head over to MindTap and do our 7-1 work together where we will be putting together a net income statement.